Hello everyone, I hope so you will be fine. So guys, today we are going to talk about mergers and acquisition. Actually, it is a theoretical topic. And this topic is from Unit 8 and it is relevant to corporate finance section. Okay. So here we go. First, we are going to discuss the definition of mergers. So what is merger? So here we go. Merger mean to say merger is a business transaction in which an acquiring firm absorbs a second firm. So, for example, we have two companies, company A and company B. So, in merger, what will happen? The company A will absorb the company B. Okay, and here company A will continue to exist and company B will dissolve. So, once company A absorb the company B, so what will be the company remaining company? The company A will be the remaining company. So B will be eliminated. Okay. So this is called what the merger. Like simply the acquiring firm absorbs the second firm. Here acquiring firm is the company A. Acquiring. Okay. And the company B is the firm which is going to be absorbed by A. So here this is the definition of a merger. So then please remember, as I told you, the acquiring firm, which is in my example, company A, remains in business. Okay. And what about the company B? The company B will dissolve. Okay. So they're saying that the acquiring firm remains in business as a combination of two merged firms. Okay. So obviously, whenever we do mergers, so obviously we need the approval from shareholders. Okay. Now there is another definition which is called consolidation. I'm going to explain because consolidation is slightly different than merger. So in consolidation, what will happen? For example, if you have, let's assume, if again we have a company A and we have a company B. In consolidation, what will happen? It is almost similar to merger, but what will happen? So the company A and the company B, once they will consolidate, so the new entity will be formed. New entity, for example, A, B and company. Okay. So this new entity will be will formed. Okay. This is what is called consolidation. So neither of merging entity survive. So A will not survive, B will not survive only. So the new company will be formed, which is called what? A and B company. This is what is called consolidation. So don't mix it. So please here is the key difference between these two. Okay. So again, we are discussing now the difference. So with this key differences, you can understand what is the merger and what is consolidation. So number one, so in merger, so what will happen? One company survive. Okay, as I gave you example, if A absorb the B, only acquiring firm will survive, which is A. So B will not exist. But in consolidation, both companies dissolved. But what it means, like for example, A, when A is going to consolidate with the B, so their existence will be eliminated and new company will be formed like A and B. So this is what is the consolidation. Second thing is what? Under merger, no new entity is created. As I told you, once A will absorb the B, only A will continue. Okay. And B will dissolve. So that is why no new entity is formed. No new entity is created. But under consolidation, a new entity is formed. As I give you example, for example, if A is going to consolidate with the B, so the new entity will be found, which is A and B. Here, example for merger, these are the practical example. For example, Disney company, it is this is the company actually in practical world. So Disney acquiring uh, Pixo. Okay. So when Disney acquired the Pixo, only Disney survives and Pixo company dissolved, right? So this is what is example for merger. But in consolidation, so this is very, famous company in the pharmaceutical sector. So what happened in the consolidation in the practical world? So Glaxo Wellcome and SmithKline Beecham, these were two different companies. Let's say this is the one company, this is the second company. So once they consolidated, what happened? So Glaxo Wellcome and SmithKline Beecham. So once they consolidated, so new companies formed, and that company is called now GlaxoSmithKline. Okay, GSK. It is very famous pharmaceutical company now. So maybe you can also notice on certain medicines. So GSK is written. Okay. So actually it was consolidated. These two companies were consolidated, Glaxo Wellcome and SmithKline Beecham. Okay. So I hope so this difference is clear. So you should know what is merger and what is acquisition. So now I'm going to explain three types of mergers. Okay. So the first one is, let me tell you here what is the horizontal merger. Okay. Then we got vertical merger, and then we also got conglomerate merger. So these are three different types. So what is horizontal merger? So here, please remember, horizontal merger occurs when two firms in the same line of business combine. For example, just give example, let's assume we got a Toyota company, okay, and we got a Honda company, let's assume. If we know these two companies are in the same line, right? So they are similar in terms of product, in terms of services, in terms of market, right? So if these two competitors, because they are in the same line of business, if these two competitors combine, so this is what is called horizontal merger. Okay. Now we got here vertical merger. So please remember, vertical merger is also called vertical integration. Okay. So what is vertical merger? Here, vertical merger combines a firm with one of its supplier or customer. So you have to focus here on the supply chain actually. For example, I'm just giving example from UAE market. Let's assume we got a Toyota company, and Toyota have their customer, for example, Al Futtaim. And Toyota also may got some supplier also. Okay. Let's assume service company. I'm just giving example. Okay. For the sake of understanding. Okay, let's say we got one S company. S company is the supplier of Toyota, and Toyota is the supplier of Alpha Theme. So if you will look into this relation, so Toyota is the customer of service, Alpha Theme is the customer of Toyota. You can say this way also, right? So if any two firm within the supply chain, if they will merge, that is called vertical integration. For example, if Toyota will merge with Alpha Theme, or if Toyota will merge with their its own supplier. So this is called what? Vertical merger. Understood? And now we got here third definition, which is called conglomerate merger. Okay. So what is conglomerate merger? So here a very key definition is there. So conglomerate merger involves two unrelated firms in different industry. Like for example, I'm just giving you example for the sake of understanding. Let's say we got a company A. Company A is in the cement sector, and we got, for example, company B. Company B got, let's assume they are into the pharmaceutical sector. Okay, I'm just assuming. So they are into pharmaceutical sector. Now, guys, please remember, once these two companies will merge with each other, so this is called conglomerate. Why? Because these two firms are unrelated firms. What does mean by unrelated firms? They are not similar in terms of product, so their products are different. They are not similar in terms of service, so their services are different. They are not similar in terms of market, because obviously company A might target different market, company B might target different market, right? So they are not in the same sector. So these both companies are from different sector, okay, from different industries, you can say. If these two companies will merge, so this is what is called conglomerate merger. By the way, guys, uh, uh, once conglomerate mergers happen, so what will happen actually, guys? Actually, their purpose is to diversify. So diversification is their purpose, right? Diversification means what? So they actually, for example, they actually they want to diversify their investment. So they want to reduce their risk, you can say, right? Because maybe in certain situation, maybe if cement sector is underperforming, maybe pharmaceutical sector might perform well, right? So gain on the one side can net off the loss on the other side. So this is what is called conglomerate merger. Now for the conglomerate merger, we got a very practical example. For example, Amazon and Whole Food Market. So this merger happened. This is the conglomerate merger. It happened in 2017, right? So we know the Amazon is primarily it is an e-commerce platform, right? And technology company. This Amazon company acquired actually Whole Foods Market. It's a grocery retailers. So you can see here now their products are different, okay, or their market is different. So their product or services are different. But so this was conglomerate merger because Amazon merged with Whole Food Markets. So please remember the businesses were unrelated but allowed. Okay, now it's kind of advantage, but allowed Amazon to diversify into the grocery industry and explore synergies between e-commerce and physical retail. So what are the synergies? I'll talk about the synergies after a few minutes because this is one of the benefit of merger. So that I'll explain, don't worry. Synergies means a benefit. They will get the benefit, okay? That I'll explain. Now, guys, we got here some other information. So a merger is usually a negotiated arrangement between a single bidder and the acquired firm, right? Obviously, for example, if company A is going to merge with the B, so obviously the management of both companies will negotiate with each other. So here, let's assume company A could be the bidder and B could be the target or acquiree, okay? Or the acquired firm, which is going to be acquired by company A. So here, please remember when company A, let's assume merge with the company B, or so what you can do, maybe the company A, it's just understanding. I'll give you example also. For example, because obviously you can say the company A is going to merge with the company B, right? So let's assume you can say this way company A is going to absorb company B. Let's say this way. Company A is going to absorb company B, right? So obviously B will dissolve, only A will continue. So here what the payment which maybe A will make to the B, it is mostly in stock. In stock means say what? So company A may issue their own stock to the company B, okay? As a consideration. Now, please remember here the bidder. Let's assume the company is the bidder who is going to absorb. Bidder is often a cash-rich firm. Obviously, they have some cash. That's why they are going to absorb other, right? So a bidder is often a cash-rich firm in a mature industry. What it means in a mature industry? Maybe A, maybe just giving example. Maybe A is in mature in industry or into saturation market. In mature industry means maybe they cannot grow in its own industry, so that is why they are seeking a growth possibility. And now the company B, so the acquired firm which is company B is usually a growing and in need of cash. Okay, maybe this company is having a potential to grow, okay, but they need also cash. So in that scenario, obviously A have a cash, they need a cash. A have a cash, B need cash, obviously, so then they can merge, right? Now we have a practical example. For example, Facebook acquired Instagram back in 2012. So please remember, so this is now just a few discussion point. And it was a negotiated arrangement because Facebook negotiated with Instagram for $1 billion deal. Okay. And stock payment, what? So the deal, as I told you, mostly we make the payment in stock, but it's not necessary. We can give the cash as well. Okay. So the deal was partially paid in Facebook stock. Like for example, if the deal was for $1 million up to $500 million, stocks were given of the Facebook, aligning Instagram founders' interest with the Facebook growth. Because once Facebook gave their own stock to the Instagram owner, so obviously now Instagram owner they will have interest in Facebook also, right? If Facebook will grow, so Instagram owner who got the stock of Facebook, he will also grow. Now, bidder profile, it's just a discussion only. So Facebook was a cash rich firm. Okay, they were having a cash. was expanding in social media space to maintain growth, and they were looking for the growth. So the acquired firm, which was the Instagram. So Instagram was a growing firm. Actually, it is okay. So it was a growing firm with significant user engagement, needed resources to scale operations. So they were in need of cash. So that's why Facebook offered the deal for $1 billion. Okay. Now we got third definition. Please don't mix, guys, because these are really critical definitions. So most of the time students, they are confused. What's the difference between mergers, consolidation? And now I'm going to explain another term which is called acquisition. Okay, which is called acquisition. So please adjust one more time, small recap, because here we will have a slight difference. Here, if A is going to absorb B, only company A will continue, right? And in consolidation, if A is going to consolidate with B, so both company will cease to operate, only new company will be formed like A, B and company. Now, what will happen in consolidation? In consolidation, for example, guys, for example, we got a company A, sorry, in acquisition, okay? We got a company A. Now I'm explaining acquisition. We got a company A, and company A is going to acquire company B. Okay, now what does mean by acquire? Okay, so company A actually is going to get the control over B. And maybe if you have studied in accounting ever, so when company A acquired another firm, okay, generally what? So generally there are two types of acquisition, okay? Sometimes we can buy all assets of company B. Like A will acquire all assets of company B. So this is called acquisition through the assets. And this is little bit more critical if you will acquire B, if company A will acquire B through the acquisition of assets, it is actually more critical because company B have a lot of assets, right? So obviously for their real estate deeds, you need to finalize, right? Intellectual properties like patents, trademarks, we have to deal with them also. We have to deal with the leases contracts if company B is having any contract. So it is really complicated. So this is the one way to acquire. Okay. And the second way is what? There is another way to acquire. Okay. The company A can acquire. This is the second way now I'm going to explain. If company A is acquiring B, the second option is we can acquire the majority of voting rights, which is called 50%. Okay. So if you will acquire more than 50% of voting rights means a common stock of company B. This is called what? Acquisition. And now I'm going to explain here some key points here. So here we go. And obviously, once you will acquire B company by acquiring all assets or greater than 50% of voting rights, so it means company A is going to have a control over B. Okay, it doesn't mean A will eliminate dissolve. We know A will also continue, B will also continue, but A will have a control over B. Okay, the control over B. Control mean to say what? So the control actually it is the direct or indirect ability to determine the direction of management and policies of the investee. Like simply investee here is the company in which you are investing. So which is the company B here. So A will have a control over B. Control mean to say A will have a ability actually to determine direction of the B, direction of the management or of the company, or A will have a ability to determine the policies of the B. Okay. So this is what is called control. In simply, so decision making power will be with the A. That's it in simple words. So that is what is called acquisition. Okay. An entity, please remember here, is presumed to have control when it acquires more than 50% of voting interest, shares of common stock of the second entity. As I give you example, guys. So sometime you can acquire the other firm by acquisition of all the assets of target firm, or target means the company B. Okay, or you can get the control by having by purchasing more than 50% of the voting rights. Okay, So now here we are discussing here what are the some key points, okay, under if you are doing acquisition of all a firm's assets. So this is the first choice I'm going to explain. Okay, you got the first option. You can acquire all of the firm's asset. So please remember, if as a company A, you are acquiring all of the firm's assets. So it's not easy. So obviously, if you want to buy all of the firm's asset means a B's asset. If company A want to buy B's assets, so it requires a vote of that firm shareholders. So it means you need approval from the shareholder of the B. Okay. It is also entails the costly transfer of legal title. As I told you, if you are acquiring asset, it's similar like if you are buying a car, so in UAE, so what you have to do, obviously ownership will be transferred, you will pay money for that, right? Insurance you need to get, you will pay money for that, right? Passing you need to get passing of the car, so you have to pay for that. So see, only for one car you are spending maybe 2000 dirham, right? Or 1500 dirham, depending upon the nature of insurance. So similar here you are acquiring bundle of assets, right? So it will become costly, right? Because you have to transfer the assets, you have to transfer the legal title of the assets, right? But what is the plus point of this? Obviously, if you're acquiring the firm's assets, the plus point is that you will not have any non-controlling interest, a minority interest you will not have, because all is all yours. Okay. So, but here we got a positive point. It avoids, like if you will buy the asset, it avoids the minority interest that may arise if the acquisition is by purchase of stock. Obviously, if you are acquiring through this technique, like if you are acquiring the company by having more than 50% of voting rights, for example, if you got 60% of voting rights, so it means your controlling interest is there, but you got NCI also non-controlling interest, which is 40%, which is called minority. So this minority will arise in case of acquisition through the stock, but in this minority will not be there if you are acquiring the assets of the target company. Okay, I hope it is clear, guys. So now here we got here acquisition by stock. This I'm going to explain now. Acquisition by stock. So please remember these points I have already explained, right? To you guys, like if you're acquiring through assets, so these it will become difficult for the acquirer, because you have to deal with the real estate deeds, you have to file the deeds, you have to deal with the patents, trademark, intellectual property, you have to deal with the leases. So this I have already explained. So now I'm discussing an acquisition by stock. If company A is going to acquire the company B, and you are going to acquire the majority of the voting rights, means more than 50%. So then what? An acquisition by stock purchase is advantageous because, like, it will give you benefit because it can be affected when management and the board of directors are hostile to the combination. What it means? It means, even for example, board, like let's say company A is acquiring B, okay? A is acquiring B. A is acquiring B. So now B's management, or maybe the board of directors, so they are opposing this acquisition. So they don't want A to acquire B. So the management and board is opposing this deal. So now what? So in that scenario, so the acquisition of stock will become advantageous to the A, because they can directly connect with the shareholders and they can buy the shares from the shareholders. Okay. And then they're saying that, and it does not require a formal vote of the firm's shareholder. It's another point, when we acquire the other firm by by buying their assets, you need formal approval of the shareholders. But when you are buying another firm through the share, so you don't need formal approval from the shareholders. Now, so how would you buy the share? This is the point now, right? How would you buy? Even the management or the board of directors of target company is, if they are opposing this deal, so then how would you buy? So simply, you can make a tender offer. Okay, the tender offer. So please remember here, tender offer is what? Tender offer is a general invitation. Okay, by an individual or a corporation. What it means? Simply the acquirer, the firm he is going to buy. For example, A in my example. So they will make a tender offer. Tender offer means a general invitation to all shareholders of B. So they will offer, A will offer, make a tender offer to the B shareholders, and A will quote the price. Okay, maybe A is saying that we are ready to buy the stock at $50 each. Okay, so this is what is tender offer. Tender offer is a general invitation by an individual or a corporation to all shareholders of another company, okay, to tender their shares for a specified price. Okay, obviously A will offer a very good price, maybe they might offer slightly higher than even the market price. Okay, so obviously these shareholders, they might be interested in selling their stocks to A. Okay, so this is what is called acquisition by stock. Okay, then guys, please remember here, obviously when A, I'm just going to give you example, when A is going to acquire B, okay, here, please remember here, if B's management or the board of directors, if they are opposing this deal, okay, they don't want, B's management and the board of directors, they don't want A to purchase. So, and still A is trying to acquire the B, okay, even the management and the board is opposing. So this is called what? Hostile takeover. Hostile takeover. Okay, not friendly, hostile takeover. Because B's management, they don't want to sell this business, but A, they are forcefully, they are trying to buy this. Maybe they are making tender offers to the shareholders at higher prices. Okay, and shareholders, they might sell their interest. So if this kind of situation is there, this is called hostile takeover. So here we got our definition of hostile takeover, because there is another definition which is called friendly takeover. Okay, friendly is slightly different. So friendly means what? B's management and the board of directors, they are not opposing. They are also ready to sell, and they are trying to convince, they are trying, B's management and the board, they are trying to convince, okay, the shareholders of B to sell the stocks to A. So if it means, if B's management and the board is not opposing, so then this is called what? Friendly takeover. Okay, so we got hostile also, we got friendly also. So here just I'm going to go through the definitions. So we got here definitions now. This is for hostile, where B's management and the board, they are opposing this acquisition, but still A is making tender offer, okay, to the shareholder. So this is hostile takeover. So here we got a definition now. I have already explained, just I'm going to go through. They're saying that a hostile takeover occurs when the acquiring company, means A, attempts to take the control of target company means a B, like A is trying to take control of B without the approval of its management or the board of directors. So this is hostile, I have already explained, right? So here in hostile, what will happen? The acquiring company, which is A, may directly appeal to the target shareholder, which is B. Like A can just directly appeal to the B shareholder, okay, through the tender offer, okay, or they will try to replace the board of directors, which is called proxy fight. Proxy fight is what? Let me explain quickly. For example, company A, they are convincing shareholders of B that your board of directors are not good, replace them. Why A want to replace B's board of director? The reason, because they are opposing this deal, right? So this is what is called proxy fight. Okay. So I hope so it is clear, and please remember this point can be tested in your example. Okay, this point which I'm going to explain now, it can be tested in your exam. Sorry, okay. So they're saying when the takeover is hostile, forcefully you are trying to buy other business, okay, the target is usually in a mature industry. Okay, so the target is in which industry? Mature industry, and is underperforming. So you are in mature industry, but it is underperforming. So more than one bidder may emerge. Maybe let's assume two or more investors, they can come. Management ownership is likely to be low. Payment is more likely to be in cash. It's not necessary in cash, but you may, the bidder may offer payment in cash, and initial bidder is probably a corporate trader. Okay, because the bidder maybe he knows, or the investors maybe they know this company is underperforming, B is underperforming, and once they will buy, so they can obviously can take it to the other heights, okay, in the industry. So that's why they are interested. Remember this, okay, in hostile takeover, generally the target company is in the mature industry but underperforming, okay. Then example here, we got example, like we got a Kraft Foods take over Cadbury into 2010, okay. So they acquired Cadbury in 2010. Okay, Cadbury's management initially resisted the acquisition. It means it is going to be hostile, right? But Kraft purchased it aggressively and eventually succeeded. So because they made offer to the shareholders directly, even the management was opposing. Now we got a friendly takeover. I have already explained what is friendly takeover. That here, obviously, if A acquiring B, okay, so B's management and the board of directors they agreed, they agree, for example, to sell their business, and they will try to convince the shareholders of the B. This is friendly now, okay, not hostile, friendly. So here a friendly takeover occurs when the target company willingly agrees to be acquired. Oh, they want to sell B actually. Both companies negotiate terms and work collaboratively to finalize the deal. Okay. So here, this I have already explained. Just these are the key features of friendly. Number one, mutual agreement. The management and the board of target company approve the acquisition. They don't oppose negotiated terms. Both parties agree on the price, structure, and other details of the transaction. So they will decide, okay, at which price they will convince the shareholder to sell the stock. They will decide less resistance, obviously, from the board of directors and the management. That's why it's friendly. Okay, so employees, shareholders, and stakeholders of the target company are more likely to support the deal. They are not opposing the deal. So smooth integration means a post-acquisition operations and cultural integration tend to be more seamless. Simply like it will be a smooth process of acquisition. You can say this. Example, we got here example like Disney. They acquired a Pixar company in 2002 and it was friendly takeover. Okay. Because both companies agreed to the deal and Pixar management supported the acquisition. Now, guys, we are going to discuss here some other plus and negative points. So please remember here, sometime we are discussing here, uh, we have a different reasons for seeking or avoiding merger or acquisition. So I'll explain these 2 points. One is the positive point, second is the negative point. So here we go. Don't worry, so it's just general point. These are general point. So first I'm going to explain what. Let's assume company A, I'm going to give you example. For example, A is going to merge with the B. Okay. B's management or the board of director. Okay. They want to merge with A. But what I said, they want to merge with the A. They want to merge. But this merger or acquisition is not in the interest of shareholders. In the interest of shareholders. Actually, this merger and acquisition is not good for shareholders of the B, but still B's management or the board of directors, they want to sell this or they want to merge with it. Why? Now the question is why. The question is because B's management and the board of directors they think that oh their salary will increase because they are going to be part of big company, so their salary will increase. They will get more fringe benefits. They will get more power. They will get more prestige. Okay, and because they are going to manage a large enterprise, so this is what is the one negative point. Even this merger and acquisition is not in the interest of shareholder, but still board or the management they want to merge with A because they are looking for their own interest, not for the interest of shareholder. So we can say simply this conflict of interest, right? Sometimes There is a conflict of interest, but board of directors, they are looking for their own interest, not the interest of shareholder. So these things can happen. On the other hand, for example, now let's change the example. For example, A is going to merge with the B, and now the board of directors and the management of the B, they are opposing this deal. They don't want to merge. The reason is that even this merger is in the interest of shareholder, but B's management or the board of director, they are opposing this deal. Why they are opposing? Because they know maybe once A will merge with B, so they may lose their jobs. Okay, they have a fear of being fired. They have a fear of being replaced. So that is why they don't want this merger. But even this merger is in the interest of shareholder, right? So this is what is the plus and negative points. I have explained these 2 points. You can go through. This point is the example of this, and this point is the example of second. Okay. The first I explained, when the board was not, when the board want to sell, and second example is I gave you when board they don't want to sell. Okay, so these 2 points I have explained now. There are also some other benefits to the entity as a whole. Okay, what is the benefit? Number one, if you will, let's assume if you are having conglomerate merger, two unrelated businesses are going to merge. So first, number one is what? So diversification will be there, right? So investments are being diversified. So you will get stable earnings. Stable earning means what? Even if on the one side you are having loss, so most probably on the other side you will have a gain. Okay, so gain on the one side will net off the loss on the other side, and you will get stable earning. Okay, and reduce the risk to employees and creditors also. Obviously, once the merger is there, creditors feels more confident. Oh yes, so now it's a big company. We are selling things to the big companies now, right? So their confidence will increase. Even the employees' confidence will increase. Oh, they are working in a bigger company. So this is another benefit. Okay, now guys here, let me explain the main point. So this is what is the main point here, guys. Sometime, guys, please remember this is also important point. Let me explain this with the help of examples. Because benefits we are discussing, right? So this point I'm going to explain here. Number, for example, A is going to merge with the B, okay? Or A is going to absorb the B. And now what is the A intention I'm going to explain? A intention is that they know, for example, they offered to not Insta, for example, they offered to be, let's assume, $1 million, let's assume. And now company A, they know that the company B value is 1 million, which they are paying right now. But if they will break this company later on, and they will sell their assets individually, so they may get maybe 1.5 million by selling their assets. So this is the intention of A now to acquire the B. Okay, because they will break this company, and they will sell their assets individually, and they can make profit of 500,000. Okay, because they paid 1 million to B, but they can sell it for 1.5 million assets individually. So this is the intention. Sometimes this kind of benefits you will also get. Now, how it is written here, look at here. A firm maybe target, if it is breakup values. Breakup means if you will break that firm, maybe the breakup value exceeds the cost of acquisition. Cost of acquisition is 1 million, but if you break the firm and sell their individual asset, you can get 1.5 million. So these kind of benefits you can also get. Okay. Now another benefit. What is the other benefit? This point I'm going to explain. Obviously, if let's assume if A is going to merge with the B, so please remember here. So if obviously they are, it is going to be a now a big company. For example, Imar. If they are going to merge with Nakhil Group, let's assume. So it is going. They are going to be a big firm now, right? It will become very big firm. Okay, especially in the construction industry. So what will happen? So number first benefit is what? Competition will be reduced. Previously, maybe Imar and Al Nakhil, they are competitors of each other. Now, no more competition, right? Right. So this is also another benefit. And now I'm going to explain synergy. This is really important. So most of the time we say this is the positivity of the merger that we will get synergy. Synergy is what? How we can define the synergy. Synergy. This is a very simple definition. First, I'm going to tell you here. in layman language. For example, generally in mathematics, we say 1 plus 1 equals 2, right? Synergy mean to say 1 plus 1 equals 3. Don't say I'm doing incorrect math. I'm going to link this concept now. So 1 plus 1, 3 means say what? For example, if let's assume this is the company A, this is the company B. Okay, let's assume A company individual value is $1 million. If they will merge with the B also individual value is 1 million. If they will merge, maybe their value will increase. Why? So maybe value will not be 2 million, value will become maybe 3 million, 4 million, right? Reason. So this is actually synergy. Synergy, how it is defined, this is the definition of synergy. Synergy exists if the value of combined firm exceeds the sum of the values of separate firms. Let's assume the value of combined firm is 2.5 million. But if you will sell one individually, second individually, maybe you will get only 2 million. But if you will combine, maybe its value will become 2.5 million. Now, okay, now which kind of synergies you are getting? Okay, why your value will increase? This is the question, right? Why through the merger or acquisition value is increasing? What's the reason? Number one, there are so many things are there. So please remember here, uh, here synergies are also explained here first, then I'll answer the why. So when two companies merge, they might save money. Yes, they can save money. For example, previously they were having one IT department for A, second IT department for B. Now they can have only one IT department for both companies. So cost is being saved, right? So they can also save money by sharing resources like office spaces or staff, improve efficiency or combine strengths to grow faster. The extra benefit from working together is called what? Synergy. This is another definition. Whatever extra benefit you will get by working together is called synergy. Okay. Now the question is that why the firm value is increasing once they merge with each other. So number one, so you may get operational synergy also. Operational synergy is what? Operational synergy arises because the combined firm may be able to operate more efficiently. Why? Because uh, your production will increase, for example, for combined firm. Once production will increase, maybe your per unit cost may decrease, and you can get economies of scale also. So it's operational synergy. So operational synergy rise because the combined firms may be able to operate more efficiently and reduce cost. So the new firm may also gain a new product line and the stronger distribution system. For example, maybe previously A were not having stronger distribution channel, but B were having. Now if A and B will merge, A will also have access to the same distribution channel, right? And obviously we will our product line will increase also, right? A and B's product line, once they will come together, so their product line will increase, their number of customers will increase. So definitely they are going to get operational synergy. And then we got a financial synergy. What is financial synergy? Financial synergy may reduce the cost of capital. Do you remember what is the cost of capital? It is the cost of the funds which we raise and use. Okay, like for example, cost of equity and cost of debt. When we calculate their cost according to their weight, it's called weighted average cost of capital, right? Financial synergy may reduce the cost of capital also for both firms because the cost of issuing both debt and equity securities is lower for the larger firms. Okay, and it is very higher for the smaller firms if you're issuing stock. So another benefit is the availability of additional internal capital. Okay, another benefit, your asset base will increase also. You can take more loans, so your debt capacity can increase. Okay, so obviously if debt capacity can increase, maybe introduction of debt into capital structure may reduce your cost of capital. By the way, what is cost of capital? We have already studied, okay? If you have not studied, you can watch the video. So these kind of financial synergies we get also, okay? Then guys, now we are going to discuss now defenses against takeover. So here we have small but so many definitions, how we can protect ourselves from the acquisition. For example, let's assume company A is going to acquire B, okay, and now B want to defend this takeover, so they don't want to be acquired. Okay, so which kind of defensive tactics the B can apply to protect this company, okay, to protect B from the acquisition. Which kind of defensive, which kind of defense tactics they can use. So those things we are going to discuss. Okay, how, in simple words, how B can protect itself, okay, from this acquisition. So first, defense is called Greenmail. So please remember, Greenmail is a term which is very famous in the finance. Okay, so let me give you example. For example, A is trying to acquire B. Okay, it's a hostile takeover. Hostile, do you remember? The management or the board of directors, they don't agree. They are not agree to sell this company. But A is forcefully buying. Okay, forcefully buying. A is forcefully buying the B. This is hostile takeover. How B can protect now? How? So if a management and the board are opposed to the takeover, yes, they are opposing this acquisition. So hostile. Obviously, in hostile, what will happen? Management and the board, they are not agree to sell the company. But A company will make tender offer, right, to the shareholders. General invitation to the shareholder, right? Maybe at higher price to buy the stock. Now what? So the potential acquirer is offered opportunity to sell his or her already acquired shares back to the corporation. What it means? Here, here, let's assume, I'm assuming, let's assume company A has already acquired through the tender offer, for example, 20% of the stock. A has acquired 20% of the stock. Even the management and the board, they are opposing this acquisition, but still they are successful in purchasing 20%. Now what? Simply, now Greenmail is what? B. What? How B can protect itself? B is saying that B is offering to A that please sell back these 20% shares to us at higher prices. For example, maybe if A paid, let's say, $1 million for this 20%. So B would say, okay, I'm ready to pay 1.2 million or $1.5 million for your investment, and please sell back these shares to us. This is what is called Greenmail. Okay. So this is the one tactic. So you can ask the bidder who is acquiring your stock. You can ask him. You can ask the company, ask the acquirer to sell his or her already acquired shares back to the target company. Okay, and obviously you will pay some extra money for this repurchase of stocks. This extra money actually is called what? Greenmail. I hope it is clear, right? So you can go through this story. And there's another concept when we obviously buy back our shares from the acquirer. So in conjunction with the Greenmail, because we are paying some extra money to the acquirer to buy back our shares. So in conjunction with the Greenmail, management may reach a standstill agreement. What is standstill agreement? Standstill agreement means say what? So you are doing agreement with the bidder, with the acquirer. So in which through this agreement, the acquirer agrees not to acquire additional shares. So he will not buy any more shares from the market. Okay. This is called standstill agreement. So standstill agreement can work with the green mail concept. This is the first tactic, guys. Absolutely clear. Okay. Now there is another tactic which we can use. So that is called what? Corporate charter. Corporate charter, it's also called staggered terms for directors. Okay, so let me give you example here first. Okay, actually, guys, let me explain first what is corporate charter, and then I will tell you how staggered terms for directors work as a defensive tactic. So what is corporate charter first? Actually, guys, you know, corporate charter is a foundational document. Okay, it's a document that outlines the rules and regulations governing a corporation. Okay, and including how it operates and how decisions are made. Simply, this is the document in which all the rules and regulations are written, which we use to run a company, and which we use those rules and regulations to make decisions. Okay, now in that, okay, you can say it's a document. Okay, legal documents. So now you can just what? You can add some terms in corporate charter. in corporate charter. So as a company, you can add some terms in corporate charter. Okay, though which terms, especially this term, staggered terms, what it is. Staggered terms for directors. Staggered terms for director means what? For example, I'm going to give you example for staggered terms for the directors, and then I'll tell you how it can work as a defensive tactic. Okay. See here we go. For example, we have a total 15 board of directors. Okay. Now what? We made a clause, we made a provision in the corporate charter that in one election, there is election every year, right? In which major decisions are taken, maybe shareholders can also elect the board of directors, etc. Okay. Now what? How staggered terms for directors can work? So we made a provision, or we added a clause in the corporate charter that in every election we can just change or replace only two directors, for example. Now what? It means if the acquirer is company A, if he obviously once he will acquire the B, so acquire company A want to bring their own board of directors, right? They don't want these board of directors, but you made a terms that every 1 year, every election year, so you can only change two directors. It means here company A almost need 8 years now, okay, to replace all these 15 board of directors because two every year, right? Okay, we have total 15. So almost they need 1, 2, 3, 4, 5, 6, 7, and almost 8 years to replace this 15 board of directors. Because if every year they can replace only two, so this will become less attractive. This class, obviously due to this class, this acquisition will become less attractive to the acquirer, and maybe the acquirer may think, oh, I need 8 years to bring my board of directors in the board, so maybe he will not buy your business, right? So this is what is called staggered terms for the director. And by the way, these terms, you have to amend the corporate charter. Corporate charter is the document, right, in which rules and regulations related to governing a corporation is written. Okay, so this is staggered terms. Okay, and obviously, okay, now we got another concept which is called golden parachutes. It's another defensive tactic. Okay, and golden parachute. Okay, one point I have skipped, guys. Under this staggered terms of directors, and you can add also one more clause in the corporate charter that if you want to change the board of directors, you need a super majority. Super majority means what? For example, maybe 80% or 90% shareholders should agree to change the board of directors. Okay, even two board of directors you are changing, but still we need super majority. And obviously, if you need a super majority even to change two board of directors, and overall the acquirer need 8 years with super majority every year. So obviously this acquisition will become less attractive. Okay. So now it's completed. Now, guys, I'm going to discuss another defensive tactic which is called golden parachute. Okay. What is golden parachutes? So please remember. So okay, so golden parachute, what it means? So golden parachutes are again provisions, okay, passed by board of directors, requiring a large payments to specified executives if executives are fired. Okay, so again you can amend the charter. Okay, you can put the clause there. If anyone will fire or replace the board of directors, so company has to pay, for example, hefty amount to the board member who is being replaced. So obviously this is called golden parachute. Okay, and obviously once acquirer, he will think to buy the company B, and obviously he will also think, okay, if he want to replace the board, he has to pay the hefty amount for that. So that is what is called golden parachute, and this can work as a defensive tactic also. But shareholders are not happy with the golden parachute. Okay, and in the past, for many companies, whenever golden parachutes kind of provisions are there in the company's charter, so shareholders they file the case also, because obviously sometimes here board of directors they're protecting themselves also, they are protecting their jobs as well, right? Not only they are protecting the company from acquisition, they are protecting their jobs as well. So that is why shareholders have often been unhappy with the golden parachute. Okay, so we got here now fair price provision. It's another provision. Okay, it's another clause which we can add in the charter. Okay, so here we go. What is the fair price provision? Fair price provision means what? Let me give you example first, then I'll explain here. So example is that, for example, A is acquiring B. Okay, now what? A is contacting shareholders of the B, right? And what A is saying that, for example, there are let's assume these are the shareholders. Just let's assume first company A is paying maybe the market value or above the market value of the stock they are paying to this shareholder. Let's assume this shareholder owns 30%. We got another share, or maybe this own 40%. We got another shareholder who owns 10%. Maybe if they are paying, let's say $50 per share, so they may also pay here $50 per share, or maybe 50. Okay, now third example, I'm just giving example. For example, here we got a 1% also. This shareholder owns 1%, and he is also paying 50. And this person, for example, is owning 1% also, and here they are paying okay only 30 dirham, $30 per share. Now here what? It means company A is not dealing equally all the shareholders, and this is what this is what has was happened in the past. What happened in the past, guys? Uh, Actually, to some shareholders, the acquirer is paying good money, and to some shareholders they were paying less money. So that is why now company who want to protect themselves from the acquisition, so they are adding the fair price provision clause. Fair price provision clause means what? So fair price provision clause mean to say the acquirer will pay the same amount to all shareholders. They cannot, offer different prices to different shareholders. This is what is called fair price provision. So here we go. A fair price provision is a clause often included in the company's charter or by laws as part of the takeover defense strategy. How it is takeover? Its purpose is to ensure that all shareholders are treated equitably, okay, in the event of corporate takeover. So the shareholder, there should not be a discrimination with anyone. So everyone should be offered same price. So here, equitable treatment for the shareholders. This is what is the main word here. That's why we added fair price provision. And now here, how it can work. So the provision, the equitable treatment of shareholders. So if you will add fair price provision, the purpose is to treat shareholders equally. So this provision requires that all shareholders receives the same fair price for their shares, whether they sell them in the initial tender offer or forced to sell in subsequent squeeze out merger. What it means, I have already told you. Maybe to the first shareholders they offered 50, to second shareholder they offered maybe 45, to third shareholder they are offering 40. So this is what is not possible if you will add fair price provision, because everyone will be paid same price. They're saying that this prevents an acquirer from offering a premium price to some shareholders in the first stage while paying a lower price in the second stage. As I told you previously, they were to the first shareholders they were paying higher, to the second shareholders they were paying lower. This is how they were working, but now they have to pay the same amount. And obviously, due to this arrangement, so this acquisition will become more costly, right? Because the acquirer has to pay the same amount to everyone, so it will increase the cost of acquirer, and maybe this can stop the acquirer to acquire this business. Okay, now we got another uh, I mean to say we got another tactics, okay, defensive tactics, which is called voting right plans. So what is voting rights plan? For example, actually here let me first read and then I'll give you example. So there is saying voting rights plans contain provision. Okay, again it's a provision or clause that prevent shareholders who hold a certain ownership percentage from voting on the takeover issues. Okay, because generally, when you are going to sell or acquire, so obviously we need As I give you example, we need, for example, maybe the approval of the shareholders, right? In the meetings, we need approvals. But here, if you will add this clause, which is voting right plans, so maybe you can make a clause that anyone who is having more than 10% stock, he cannot participate in takeover issues. Okay, so this clause you can add here. So here an example of voting right plan is a Pennzoil company in 1980. So let's read the story. They're saying a Pennzoil adopted a plan that restricted shareholders owning more than 10% of the company from voting their shares on certain matters such as mergers. Actually, this company, they made a rule that any shareholders who is having more than 10%, so they cannot participate in mergers kind of or takeovers kind of issues. Okay, so this made it harder for hostile bidders. Like if you are trying to forcefully buying the shares, obviously it will be harder for the acquirer because they cannot participate. Okay, to gain voting control, protecting the company from unsolicited acquisition attempts. Okay, unsolicited acquisition attempts. Okay, so here simply how it is defense, you can just prevent the shareholders, okay, to participate in takeover related issues. So here we go, guys. Now we got here leveraged buyouts and going private. What is leveraged buyouts? It's another, you can say, a defensive tactics, or you can say just a concept. So here we go. Leverage buyout you can take as a just concept. What it means. So for example, please remember leveraged buyouts and going private. Okay. Okay, guys, here for example, we got a company, let's assume A. Instead of selling this company to the outsiders, leverage buyout means say what? Or I can just relate with the defensive tactics also. Okay, for example, company A, let's assume is trying to acquire B. Now what? What B is thinking now? Focus with the B now. What B is thinking? They don't want to sell their business outsiders, okay, to the A. So what B is going to do? So B, maybe they want to sell B companies. They want to sell this business to the management itself, management of this company. And what management they will do? They will take a huge loan, okay, on B's asset, and this loan they will use, okay, to buy the shares, okay, from the public, because these shares are with the public also, right? So what they are doing, so management is taking huge loan, so this loan proceed they will use to buy the shares from the public. Okay, to buy the shares from public, they will use this loan. Now what happened, what will happen? Obviously once they take the substantial loan, okay, so it's called now leveraged buy, like, right? Leveraged buyouts. Leverage means say gearing. Okay, so they have taken a loan now. So they have taken a loan. Now once they will take a loan, obviously that burden of company we will increase. And how it can work as a defensive tactic. Defensive tactic means say what? So please focus with me here. So here B's management has taken a loan to buy the shares from the shareholders. So once they will buy the shares from the shareholders, so immediately they will also apply for delisting. Okay, so they will become private businesses also, right? And now even if A is trying to acquire this B company, because it became private and shares are with only few people like management, so maybe the A cannot buy any more shares, right? So this is how it can become a def defensive tactics. But leverage buyout, here we go. A leverage buyout is a financing technique by which company is purchased, like you are buying company using, management is buying company using very little equity. Okay, how you are buying company, the cash offer price is financed with large amount of debt, and leveraged buyout is often used when a company is sold to the management or to or some other group of employees. Simply you are selling to the management or other group of employees, they are taking a loan and then they are using this loan to buy the shares from the outsiders, and then they are going private. Okay, this is what is called leverage buyout. And please remember here, but it is also used in hostile takeover. Yes, as I give you example, if A is trying to buy B, so we can follow this strategy. Okay, take a loan, okay, and buy the shares from the public and go private. Okay, this is what they're saying. The company's assets serve as a collateral. Collateral means a security. Obviously, you have given the assets as a security, and then you have taken the loan, okay, to finance this purchase. So this is what is leverage buyout and going private. I have already explained. Okay, now guys, we got some other tactics also. Okay, so we got a poison pill. So please remember, a poison pill is what? Again, a target corporation. So now, guys, we are discussing poison pill. What is poison pills? Pills actually, poison pills have two types. Let me give you example here. So first, understand what is poison pill. Poison pill means a target corporation's charter, bylaws, or contracts may include a wide variety of provisions. Provision means again clauses. For example, one poison pill I can give you example. Let's assume you got a major customer. Let's assume you got a major customer. For example, company B got a major customer. Okay, let's assume, and now it's written in the agreement which company B is having with the customer that if the management of B will change, okay, so this contract will be considered as terminated. Okay, so this is what is one kind of poison pill. So maybe if A company is acquiring B due to this major customer because maybe they are generating huge revenue, so then obviously if they will come to know about this poison pill contract or the clause, so maybe they will not buy. But most uh, common, we got two types of poison pills. Most common, two types of poison pills are, one is called what? Flip over rights. Actually, this is what you have to remember. And the flip in rights. Flip over and flip in rights. So these are two types of poison pills. Okay, flip over rights. What is flip over rights? So the charter of target corporation means the charter of B corporation may provide for its shareholders to acquire. Let me give you example here. So maybe simply let me give you example. Let's assume A is acquiring B, and in B's charter, it's flip override. I'm explaining. Okay, flip override. In B's charter, it is written that if any company will acquire, let's assume one share, so the acquirer has to give two share of A to acquire one share of B. This is what is called flip override. Obviously, once acquirer will come to know, okay, to buy one share, I have to give my two shares of equivalent value. Maybe he will not buy this, okay, buy this company. This is what is called flip override. Okay. This is what I have explained. Okay, to buy one share of the target, you have to give two shares of the acquirer. So this is not good for the acquirer. Okay, so then we got a flip in rights. This is another poison pill. Flip in rights is what? The acquisition of more than specified ownership. For example, A is acquiring B, and it's written in the B's charter. If anyone will acquire, let's say more than 20% of the shares, okay, uh, this is what they're saying. If acquisition of more than specified ownership interest like 25% in the target corporation permits shareholder except the acquirer. Like for example, maybe you have written in the charter, if anyone will acquire the 20% of the shares in that scenario, okay, the B company will issue new shares, okay, to existing shareholders, not to acquirer. Okay, not to acquirer. So it means the existing shareholders can buy new shares at reduced price. So how it can work as a defensive tactic? Obviously, uh, the shares, new shares are being issued to the existing shareholders, not to the A. Acquirer cannot buy. The other shareholders can buy. So this way, the shareholding of company B will increase again, and A has to buy more shares to acquire this business. So this is what is called flipping right. So please remember, the acquisition of more than specified ownership interest, like 25% in the target, okay, corporation permits shareholders. The target permits shareholders, except for the acquirer, to purchase additional shares at reduced price. Now here we have a key features you can understand from here. Flip and rights I'm explaining. For example, activated flip over rights activated when hostile acquirer surpasses a certain ownership threshold, like 10 to 20% of target company share. Okay, like if anyone will buy from 10 to 20% shares, okay, so then what mechanism allows existing shareholders, except the acquirer, other than acquirer, other existing shareholders, they can purchase additional shares of the company at steep discount, means say at low prices. So impact will be what? Dilutes the acquirer ownership. Obviously acquirer's ownership will reduce because new shares are being issued to the existing shareholders other than acquirer. So dilutes the acquirer's ownership percentage, making the takeover more expensive and less appealing to the acquirer. So that's why he will run away from this acquisition. Okay. We got some other, uh, I mean to say, defense tactics also. Simply, if any company, let's say company A is acquiring B, how B can protect itself, so B can issue new shares to the public again. Okay, so this way the outstanding stock in the market will increase, and now the acquirer has to buy more shares to get the control. Okay, so this is what is another tactics. Then reverse tender is what? For example, A is acquiring B. Okay, A is making tender offer to B shareholders. So B can do what? B can make a tender offer, counter offer to A shareholders. So this can also be a defensive tactic. Then guys, we got here employees stock ownership plan also. What is employees stock ownership? Like here you are actually here company is giving employees ownership plans. Okay, to simply company is giving its shares, okay, to the employees. But so today, maybe these shares will be given to the employees, maybe at the time once employees will leave or they will retire. Until that, these shares are held in the trust. Trust means it is held with the company only, but you have given this plan to the employees, right? So this way, what will happen? Please remember. So once the maybe employees will retire, or even maybe during the employment, if the shares are given to the employee, okay, so obviously now employees' interest will be in alignment of the company's interest, because employee is also kind of owner, right, of the company. So his employees' loyalty will increase because he is going to have shares or he's having shares, right? In case if he will receive the shares on the retirement, so his loyalty will increase because he will have shares in the future, and he want high share prices. Obviously his loyalty will increase to this business because he will feel he is a owner. So this is what is the employees stock ownership plan. Okay, employee stock ownership plan. So here we go. Employee stock ownership plan is a program that gives employees ownership interest in the company by allocating shares of the stock to them. Key features. Key feature is what? Structure. Shares are held in the trust until employees leave or retire. As I told you, shares will be held in trust. Funding. Obviously, so far the shares are funded by company's contribution. Okay. Cash or loans. Then objective aligns employees and company's goals, motives, motivates workforce, and provide tax advantage for the company and employees. So then, guys, we got here another point which is called white knight merger. White knight merger is what? So target management arranges an alternative tender offer with different acquirer. For example, A is trying to acquire B, but B is insisting C company to acquire this business instead of A. This is what is called white knight merger. So in the white knight merger here, the target management arranges an alternative tender offer with different acquirer that will be more favorable, okay, to the management and to the shareholders. Then crown jewel transfer. What is crown jewel transfer? Please remember the target corporation sells or otherwise dispose of one or more asset that made it a desirable target. For example, what it is? Company A want to buy B. Maybe company A is trying to buy B due to some specific technology or asset. Now what? This B will sell those crown jewel those desirable assets. If we will sell these assets to others party, so then obviously it will become less attractive for A to acquire B. So this is what is called crown jewel transfer. Then we got a legal action, another term. Legal action means, guys, simply like if A is trying to acquire B, so B can simply go to the court or can file a case against the A. Maybe it can delay this uh, acquisition, okay, or maybe you can protect yourself from the acquisition. This is what is called legal action, okay. And obviously if you will go to the court, or if you will take a legal action, so as a result, what will happen, so it may increase the cost of the acquirer, right, cost of the acquirer, and enables further defensive action, and you will get a time to apply some other defensive action as well. Is that clear, guys? If you have any question, you can ask me, please. Is that clear, please? Tell me, guys. We have few more terminologies. Let me finish those as well. Okay. Now, guys, we are discussing here a spin-off. Okay. What is spin-off, guys? For example, please remember here, let's say we got a company A. Okay. Actually, spin-off is a corporate restructuring strategy. Okay. Where a company creates a new independent company. For example, company A creates another company, creates something. Okay. Another company. And please remember, company A's shareholders will become the shareholders of the company B. In simply, company A creates another company, let's say B, and B's shares will be distributed among companies A's shareholder. Okay. But these are two independent businesses now. Okay. Independent businesses. This is what is called spin off. So, spin off is the corporate restructuring strategy where a company creates a new independent company by separating part of its operation or business unit. Okay, or maybe some of assets of A will be transferred to the assets of B also. Okay, but A has created a new companies, and A shareholders will get the shares of B also with the same proportionate. Okay, so here what is that is called spin off. Okay, concept spin off. So shareholders of the parent company typically receive shares in the new entity, as I told you. So now here we got example. For example, eBay and PayPal. You know, eBay company. Actually, originally it was eBay. So eBay spun off PayPal into separate company in 2015. This allowed PayPal to focus on digital payments while eBay concentrated on its e-commerce platform. This is what is spin-off concept. Then it can work as a takeover defense also, because dilution of value, because some of A's asset will be transferred to B, so A's value will also dilute. So dilution of value, spinning off valuable asset into new entity. Like if you will transfer valuable asset to the B, this makes the remaining company less attractive to the hostile bidder. Okay, then guys, we got here equity carve out. What is equity carve out? So please let me give you example here. Here, actually, equity carve-out means you are selling the portion of the firm. through a public offering. Okay, it provides a way to quickly raise capital and bring in new management while still maintaining a control. So let me just give you example here. Okay, for example, you got a simply equity carve out. I'm explaining here. So for example, you got here one company. Let's assume. Okay, let me just. Okay. So let's assume you got here company A, okay, and for example, some portion, some shares of company A will be sold to the public here, okay, to the public through a public offering. Okay, and how it will help the company A? Obviously, company A will get capital, okay, and they can bring new management. It's not necessary to bring new management, but company A will get the capital. Please remember, even you are selling some portion of the shares to the public, still the control is still the company A will have a control. Okay, that is what is called equity carve out. So equity carve out involves the sale of portion of the firm through a public offering. It provides a way to quickly raise capital and bringing new management while still maintaining control. So here we have key features. Here we go. Minority stake sales. You are selling only minorities. The parent company typically sells a portion, like for example, 10%, 20% of the subsidiary shares. For example, if company A is having control over B, so uh, let's assume they got 70%. A got 70% of B. So maybe out of the 70%, they can sell 10% to the public. Okay. This is what is equity. So minority they are selling. Okay, still, even you will sell 10% of the public, still you have 60%, right? So still A has control. This is what they're saying. So retained control. So the parent company retains a majority of the subsidiaries shares maintaining control. Okay. So A will still have a control over B. So raising capital, obviously the parent company raised capital from the IPO, initial public offer, while keeping a stake in the subsidiary. You have a stake. And here we got example Ford and Blue Oval. Okay. Ford carved out of its electric vehicle business. Ford carved out its electric vehicle business by selling a minority stake in Blue Wall. So you can say Blue Wall is a subsidiary of the Ford. So they sold some minority portion of the Blue Oval, okay, uh, to the public. Okay. So this is what is equity carve out. Then guys, we are discussing split up, another concept. A split up is a corporate restructuring strategy. Again, it's a corporate restructuring strategy in which a company divides into two or more independent companies. Okay, for example, A is going to divide into company B and C. Okay, with shareholders receiving shares in each of the new entity. Obviously, A's shareholder will receive shares of the B and C also. So here key features are what? Complete separation. The company fully divides its assets, liabilities, and operations into separate entities. So they are completely separate. Shareholder distribution. Shareholders of the original company receives shares in each of the newly created companies. Yes, and independence, the new companies operates independently, often in distinct industries or in the market. So they might be in the distinct industrial market. Okay, guys. So example, Time Warner or and AO. Also here in 2009, Time Warner completed a split up, separating its media and entertainment business into independent units, into independent. So media and entertainment businesses. So they uh, separated it into different businesses. So this allowed the companies to pursue their individual strategic goals. Okay, guys, I hope so it is clear. So see you next time. Rest of the things we'll discuss. Okay, guys. So our merger and acquisition is almost over. See you in the next class. Thank you, guys.